So Scott, welcome. This is going to be really fun today.
Yeah, hey, it's exciting. I love talking about 1031s and how people can use the tax code to build their empire, right? Get better returns and grow wealth. And this is a great tool to do that.
Let's walk through some of the math because I love starting small. Let's start with a single family home that maybe, by the way, this was you could do it at one point, but let's start at a couple hundred grand. Let's say somebody bought a single family home 10 years ago for 200 grand and it's now worth 400 grand. And they decide to sell. So and by the way, correct me if I'm wrong, and I'd love you to expand on this. You could take the 400 grand and roll it into another property of 400 grand or more, and you can roll the gain forward without paying tax on it if you're upgrading and you're at or more what the sale price is. Is that accurate?
Yeah, that's pretty close. That's a good way to look at it. The way you do it technically, so let's just say you bought it for 200 and it's worth twice that, it's 400. So you're going to have actually more gain than 200,000 because when you own real estate, you depreciate it each and every year.
Right.
So your gain might be 250,000. So one thing I just point out, some people go, well, I didn't know I have to recapture that depreciation if I sell it. And when we point that out, somebody that's owned a property for 10, 20 years, that's a lot of depreciation that gets added to the increase in price. So to address what you're saying there, the gross sales price is a good benchmark. It really is what's called the net sales price. So you're able to back out your real estate commissions, your closing cost, and all of that. So the two things you want to reinvest is you want to, number one, reinvest your net equity. So what you would receive on your settlement statement, take all that money, put it into new property. And then number two, you want to have the same or a greater amount of mortgage. So if you had a mortgage on there of 100,000, you want to have at least 100,000 of mortgage on the next asset. And I'll give you a little caveat is that it's not an all or nothing proposition. So if you take out $5,000, that's called taxable boot. You just pay taxes on that. Or if you go down in mortgage. So about 1/3 of all the investors do partially deferred exchanges where they maybe don't get to match it up perfectly. They go into something and there's a few $1,000s left over. They just pay taxes on that little difference, but most of it gets deferred. And you mentioned that the deferral, that's why it's so powerful. You can do this from that 200 to 400. Then you go in another house. You can do this as many times as you want. So as long as you keep exchanging from one property to the next, you're deferring taxes potentially indefinitely. And that's kind of a pretty interesting estate planning strategy, right? You don't defer paying your lifetime, and now you pass on this highly appreciated real estate to your heirs, and they get what's called a full step up in basis. So they don't pay taxes either.
Yeah, and that's the part I was heading to. So let's say you go from, let's call it 200 to 400, and then you wait another 10 years. Now we're looking at a 20-year period. Let's say you go from 400 to 800, and then there's some to your point, if you pass it on to your heirs after you pass, then that basis is gone, right? Which basically means, guys, if you sell at that point, you'd pay capital gain on everything plus depreciation recapture on everything going back for the 20-year period. But if you pass it to your heirs and then you pass, unfortunately, then there's a step up in basis, right? And so that resets. So you've basically owned the property by using 1031 for your lifetime, then moved it to your heirs, and then you pass away, and now they get it at whatever the amount is that you pass it over. Is that pretty close?
You're right on the money. You said it perfectly. And that's why it's such a great tool. If you like real estate, it doesn't make any sense to pay taxes if you're going to go out and buy more investment real estate. So you do this over and over again. And that one, you gave an example at 800,000. You might start off with a piece of dirt at 50 grand, go up to 2, 4, 8, but it could be $3, $4, $5 million of value. All of that gets a step up in basis. So it's a huge tool. And then the flip side of the step up in basis is talking about, sometimes people ask, what are you going to pay in taxes? People think that there's a capital gain tax rate. And when it comes to an exchange, it's a little more nuanced. So you're talking about the numbers there, Ken. If you do an exchange, you've got 4 different taxes if you're not going to do it that you have to look at paying. All of that depreciation is taxed at 25%. So that's higher than the federal capital gain rate. Then you've got your federal rate, which is either going to be 20 or 15%, depending upon your taxable income. Then you've got state taxes. In California, the maximum state tax rate is 13.3% on all of the gain. And then you've got a 4th tax, which is the net investment income tax, which is an additional 3.8% surtax. So any single filer that has income over 200,000 pays that surtax, and then married filing jointly over 250,000. So the point being, you've got 4 different taxes. You got to add up all of those taxes. And a lot of investors, when they see what that total tax bill is at the bottom, they go, wow, that's a lot of money. I really don't want to write a check for that big of a number to Uncle Sam.